Oops, not coming up. Ah, okay, got it. So now that's switched on. So okay, fantastic. Everything seems to be working okay, except for Twitter, but that's all right. Okay, so good evening or good morning, depending on where you are. Welcome to our latest live stream, tax. We do these tax live streams, these Q&As every week. Some weeks we do more than one. So if you have a look at tax, you'll see what the what's coming up if you want to have a look at upcoming events. So as always, we're gonna talk about all things tax, but this is just a general discussion. So don't expect that at the end of this, you'll get actionable advice. You're going to take notes and you're going to do stuff on your own, right? What we're doing is identifying general principles and general ideas that you need to take up with your chosen tax professional. So the important thing is that you need advice, right? So this is not advice. This is educational. We hope that it is educational. Otherwise, you can take it as entertainment, but this is not advice, right? There's no way we can know your situation inside out based on this exchange. You need to engage a professional who would know your situation inside out and whom you have personally engaged. So for those that were asking, yes, this is being recorded. As for those that are joining us on Zoom, you'd see that you're prompted to accept the fact that it is recorded, and it will be available on several platforms afterwards. Basically, we're going to put it on over 20 platforms. So wherever you get your favorite podcasts, you will be able to access this. If you are on Zoom and you do not want your image to be captured on the video recording, all you need to do is keep your camera switched off. Otherwise, your handsome face would be shown on the recording, and that should be okay. All right. So without further ado, I will turn you over to Ariel. Ariel, the floor is yours. Ariel, you are on mute, so you need to unmute yourself.
Oh, sorry. So thank you, Darren. Once again, thank you very much for this invitation. And hello, everybody, and thank you for joining us today. I'm Ariel Katz from Amos Katz & Co., a firm with offices in Jerusalem and Tel Aviv. I will share my presentation, and we'll have time at the end for questions that you can write down in the chat, and we'll get to that. All of your questions. Can you see my presentation now? Yeah? All right. So my name is Ariel Katz. I'm an accountant and also a lawyer. I work at Amos Katz & Co. As said, we have offices in Jerusalem, and as you can see from my view, I'm speaking to you right now from Tel Aviv. Our office was established in 1997. We rank among the 40 largest accounting firms in Israel, which means that in one hand, we are not small, meaning that we are one-stop shop for everything you need in Israel for accounting, taxation, audits, but we're not too big, meaning that our clients are not get lost here. So I said I'm an accountant and a tax lawyer. I'm teaching for over 10 years in the Hebrew University and also in the IDC. I have a gold medal from the IDC PAS, and I feel that was quite well. So after this brief, I want to speak of some interesting information regarding US and Israeli taxation, and to points with US and Israel combining the US and Israeli tax system get interesting. So the first thing I want to discuss, and assume that many of you are already aware of, is the benefits for first-time Israeli tax resident and returning resident. First-time Israeli tax residents in Israel, we usually call them Olim Chadashim, Ole Chadash, are exempt for 10 years from tax and reporting on their non-Israeli source income, and also veteran returning resident, meaning Israeli that for outside of Israel for at least 10 years, are also exempt for 10 years. If you are outside of Israel for 6 years or more, but not 10 years, you will be exempt for 5 years. Please keep in mind that you're only exempt on non-Israeli source income. I have many clients that thought at the beginning that if they receive a salary from a US company, for example, this is exempt because they thought, okay, a US company is paying me, so this is not an Israeli income, which is not correct. A salary is regarded an Israeli income if you're working from Israel. And it doesn't matter if the employer is Israeli or from other place in the world, like the United States. If you're working from Israel, it is an Israeli source income, and you have to report and pay tax on that. However, if you are the owner of this company and you will receive a dividend from this company, a dividend from a US company is regarded as a US income, meaning that you will not pay tax on that if you are at the 10 years of exemption. Please also be aware that if you're coming to Israel, you are allowed to have an deduction or accommodation year, meaning that you can have the first year without deciding whether you can back or not come back to Israel. And this is good for people that came to Israel or coming to Israel, but are not sure if they're going to live all their lives here or to come back after a few months. One of the most important tax planning for this kind of people is the end of period tax planning. A person that, for example, is in Israel for 7, 8, 9 years and is reaching through his 10 years in Israel, it's very, very important to do the end of year period tax planning to check whether he needs to move assets from one year to another, to distribute dividend, to change something. And it's always smart to consult before the end of 10 years and at least 1 year before that. So this was the first point, and I want to move forward to a few other points regarding US and Israeli taxation issue. The first point is the tax credit. As you, I assume, already aware, if you have an income from the US and the US took the tax out of it, Israel will not double tax you. However, if the Israeli tax rate is higher from the US tax rate, you will pay only the difference. This is true with respect to income tax. However, with respect to Bituach Leumi and national security, there is no anti-double taxation treaty, meaning that with respect to Bituach Leumi, you will pay double. You will pay national security in the US and Bituach Leumi in Israel. For example, if you are self-employed in Israel and you are a US tax person, you will pay both Bituach Leumi and national security. And there are some ways to deal with that. The first way to deal with that is to have your operation, have your business via a company, because companies are not paying Bituach Leumi and companies are not paying national security. Israeli companies are not paying national security. And then you can take a salary from your own company without paying national security in the US. This is one solution. There are other solutions, but please be aware that if you are a self-employed in Israel and you're a US tax person, this is something that you have to take care of. Another issue is employees' option taxation. Many employees in the high-tech industry receive options in their companies. The problem with Israeli and US taxation with respect to options to employees is that Israel want to tax you on the day you receive the money, and in the USA want to tax you for the period in which you receive the options. Meaning, let's take an example that you worked in the US for 4 years and received options as an employee. And then you move to Israel, and one day after you move to Israel, you exercise all your options, sell all of the shares, and had an income. From US tax point of view, you have to pay tax because all of these 4 years you work in the US and your options got vested. However, from Israeli point of view, if you had your gain in Israel, even if you came to Israel one day before that, you have to pay on that in Israel, and this is quite a problem. It is related to many Israelis that are going for relocation periods in the US. And also here, there are things to do with respect to that, but you probably need a specific consultation. Another issue is who is considered an Israeli tax resident. I mean, in Israel, we are checking what we call the center of life test. If your center of life is in Israel, you are regarded as an Israeli tax resident. If your center of life is outside of Israel, in the US or anywhere else, you are not regarded an Israeli tax resident. And you should know that one of the goals of the management of the ITA, the Israeli Tax Authority, one of their inner goals in the last 2 years is to make more people to be regarded as an Israeli tax resident, meaning that if you will be in Israel more than 90 days a year, not 183 days like it's today, you may be regarded, even if you stayed 1/4 of the year, you may be regarded as an Israeli tax resident. But just to be clear, this is something the management of the ITA wants to do, but it still haven't done. I mean, there's still the legislation with respect to changing who will be regarded as an Israeli resident is still not complete, but it's something they want to do. I want to move forward to a few other issues, Israeli and US taxation issues. The first of it is investing in foreign companies from both sides. Most of the Israelis that are investing in US companies are doing that via a US LLC, which is usually a transparent entity. The fact that the US LLC is a transparent entity means that in the US you will receive a K1 and you will pay the tax in your personal tax return. In Israel, basically this company is not regarded as a transparent company. However, the ITA published a circular telling that you can elect this US LLC will be regarded quite the same as a transparent entity in Israel. However, it's not a full transparent entity, meaning that according to the ITA position, you cannot offset the income and loss of two separate LLCs. I mean, if you have a profit in one LLC and a loss in another LLC, in the US you can offset them, but in Israel, according to the ITA circular, you are not entitled to offset them. So if you own more than one LLC, it will be smart to consult over this point, because otherwise you may have to pay double tax. Another issue is the US inheritance tax, meaning if a person dies and he's even not a US person, an Israeli person, but he holds US asset, he may need to pay, not him because he's died, but the state will have to pay inheritance tax. So people that are old or people that their health is not so good, or even everyone should think about how to minimize their exposure to US inheritance tax. And the way to do it is to invest in the US via an Israeli company. to use a trust or to buy a life insurance to cover your potential taxation. There is a threshold, and Darren can correct me if I'm wrong, which is around $60,000 or $70,000. It's quite a low threshold. I mean, if you have major investment in the US, you need to look out and to make sure that you are not exposed to this taxation. The next point I want to discuss is how companies are regarded as an Israeli company or non-Israeli company. I have many clients who discussed with me about opening a US company, for example, opening a Delaware company, using Stripe to open them the company. It's very cheap to do so. You pay a few $100s, you have a US company in Delaware, you have a mechanism to get funds into it via Stripe or any other software. And I also tell to these clients that they must be aware that if the management and control of this company is from Israel, the Israeli tax authority will look at this company as an Israeli resident company, meaning that this company have to pay tax and report on all of this income from Israel. And of course, the US authorities, the IRS, will want this company to pay tax in the US as well. And then we have quite a problem between the IRS and the ITA. So usually for Israeli tax resident, they have to be aware that if they open a company from outside of Israel, it will be better to put them someone to be as a manager or have some shareholders non-Israeli to minimize this exposure, or to have at least some kind of mechanism of having one Israeli company and one US company and have one to pay the other one according to transfer pricing methods in order to make sure they don't have a big tax exposure, not in the US and not in Israel. So basically discuss the problem of the LLC, that one, that if you have an income in one LLC, and you have a loss in another LLC, you cannot offset with them, one from another. There is a new approach over the last, let's say, 6 months by the ITA. They published some kind of a new circular for comments, and they may change their old approach that you cannot offset one LLC with another, but since it's still something quite in the gray zone, we don't have a full and final answer because even the ITA are not sure what will be their final DI about this issue. The next and probably the last thing I want to discuss here is US tax persons that are having Israeli exempt income. For example, if you're a US tax person and you're selling your only apartment in Israel, you will probably be exempt in Israel. However, you may have to pay tax in the US. And another example, if you have a quite minor income for a rental income below around 5,000 shekels a month, it will usually be exempt in Israel. But again, you have to report and pay tax in the US. And here I want to tell you, everyone, that if you are a US tax person, you always have to consult with two people, your US consultant and Israeli consultant, and maybe have them both speak together to make sure that nothing is missed out and that your tax planning is taking into account both your Israeli income and your US income from both Israeli tax perspective and US tax perspective. So thank you, everyone. It was a pleasure, and thank you, Darren, once again, and back to you.
Okay, thanks for that comprehensive overview. Now, I don't know if you're aware, but when you were talking, the slideshow that you put up, it wasn't moving. So it stayed on one slide. I don't know whether that was intentional or not, but anyway.
Why?
But
In my computer, it moved, but I was worried that you were not with the slides. I'm not sure.
It's okay. It's okay. I think you're pretty explicit in covering what are key points that people need to kind of keep in mind. I for those who want to ask questions, you can type them in the box below, and we'll have a look at them and we'll reply to them or discuss them in the order in which they receive. But I have some questions before we get to. So I claim my rights as the host to ask some questions before everyone else. So the idea of someone being based in Israel and forming a company, an LLC, particularly in the US. You did touch on that in a lot of detail. I know that there are websites that target people in Israel and in Europe, and they kind of give the impression that, hey, you stay where you are, you form an LLC in Delaware, and whatever that LLC does is going to be free of tax wherever you are. But I think you've made that clear that you need basically economic substance. You need boots on the ground, someone running it for you in the US. Otherwise, it'll be taxable back in Israel. That point was well made, and I think that's important that people hear. So here's my question coming out of that. Does the ITA check for substance? If so, how do they normally make that inquiry?
Okay, so usually when you file your Israeli tax return, there is what we're calling 150 form, and you have to report in this form all your non-Israeli held companies. And there are quite a lot of questions in this form. For example, do you have non-Israeli managers? How many of the shareholders in percentage are from Israel? What is the company is doing? What is the taxation rate outside of Israel? Is it an active or passive company? Where is the management? And many questions. And this question having the ITA to decide whether this is a managed and controlled company from Israel or not.
Okay, so that's important. So the actual tax return itself is from the IT, it is quite detailed. So that's where they'll pick it up. Okay, that's good to know. Now, you also went into a lot of detail, I thought, which is really good on options. And of course, especially for people working in the tech sector, it's of course quite a popular means of compensating people for taking the risk and whatever. So options comes up a lot for both of us, I'm sure. So just to be clear, like, so in the US there are statutory stock options and non-statutory stock options. Basically, if it is that you getting options as a US taxpayer, if you're getting options from a US company, chances are it may be statutory tax option. So when you awarded the option, so like many times you have to buy the options, right? So if there's a delta between the price that you paid for it and what the market value is, then the difference may be compensation to you. And then when it vests, if it is statutory tax, if it is a statutory tax option, when it vests to you, you may not be taxed on it, but when you sell it, you pay capital gains. Whereas if it's non-statutory, when it vests, it's income to you, and then you pay capital gains whenever you sell it on. And for non-statutory options, the ones that come from non-American companies, the IRS likes it when you pay that tax upfront. You determine a value and you pay the tax upfront when you are awarded options. But Israel sounds as if it treats it quite differently. So is there a difference between options that are awarded by an Israeli company versus options that are awarded from a non-Israeli company? And could you just go over when exactly is it taxable? When you get the option, if there's a delta, or when it vests, or when you sell, or all three?
Okay, so there's a difference for if you receive the option in Israeli and non-Israeli company. If you receive it in Israeli company, usually most of the Israeli companies are checking the 102 section, meaning that there is a capital gain, and only when you sell the share. I mean, only when you sell it. So you can have invested, you can keep it for many, many years, but you pay only when you sell it. If an Israeli person is receiving a non-Israeli company capital, if you receive shares, you pay, let's say, on a monthly basis or a quarterly basis. At the time you receive the share, he pays because he received the benefit. And if you then sell it, you receive the extra amount. If he's still in the US, probably there will not be a problem because US will have the first bite on his income, but he will pay in Israel marginal tax rate as soon as he's still an Israeli tax resident. Let's say he moved to 1 year of relocation or something like that. If you receive an option, this is the more problematic area, because in Israel, you should pay the tax only when not on the vesting period, but when he exercised the option into share. And then if he paid the US on the vesting period, and then in Israel, he come to Israel and then he exercises into shares, then he can find himself in a problem that US want to tax him and Israel also want to tax him. And therefore, Israel is in relocation, which received options in both Israeli, but also more important non-Israeli companies. It's better to consult before they come back to Israel, and sometimes to make the exercise, if they can, before they're coming back.
Okay. Thank you for that. Because that is obviously quite a tricky situation. Now I'm going to go to the questions. In a few questions were submitted, and Gary, I see that you typed a question below. Thanks for that. We'll get to that soon. Just quickly, somebody's asking about President Biden's tax plan and his plan. Yes, it hasn't passed, right? So right now it's still being debated and discussed in Congress. So obviously it'll be subject to negotiation, and what the White House wants, it'll have to compromise. But at this point in time, what the White House is looking for is an increase. They're looking for a lot of stuff, but for people who may be doing business internationally, like the audience here today would be, you're looking at an increase in personal income taxes. The highest marginal tax rate right now is 37, and they're proposing for that to go up to 39.6. So, depending on what your situation is, you add state income tax to it, and you kind of looking at a really high marginal tax rate potentially. If it is you have capital gains and your income is over 1 million, then the part of the proposal is those capital gains would not be given the preferred capital gains, at least long-term capital gains rates, which is half of that. Like it's 20% plus the net investment tax, but roughly 20%. The proposal is for capital gains for higher income earners to be taxed at ordinary tax rates, which is going to be huge because that basically doubles it. That's a big one. There's a step up in basis, right? So for example, if someone passes and like your parents pass and you receive property like a home from them, there's this, so the basis in that property for when you sell it on would be the value at the time when the person passed and you received it, right? But it's proposed that that whole step up in basis be removed, so the value would be, which you need to calculate the capital gains, would be when your parents bought it, so the original purchase price, as opposed to when you inherited it. So that whole step up in basis, that's a big one. They're also proposing a billionaire tax. So a 20% minimum tax, but the trick in that one is it doesn't necessarily apply to billionaires. It applies to anyone if they have assets in excess of 100 million. So that's not exactly a billionaire, right? So, and that may sound like a lot, but if you're working in a tech startup and things are going well and the valuations are being pushed up, before you know it, you may be sitting on an asset that's worth more than 100 million. And you're going to be hit with this minimum tax, even though you may not have had a liquidity event. So it's kind of messy, but it's what's being discussed anyway. They're looking to repeal the carried interest, and that's the last one I'll touch on. And of course, for those who invest in fund structures, that allows you to enjoy the returns from a fund structure at long-term capital gains rate as opposed to ordinary income rate. So that again is being proposed, but everything is subject to negotiation. So this is just at the proposal phase. This is what's being looked at right now. So I hope that answers your question. And then Gary's asking you, Ariel, a question about, so I'll read it for the benefit of those who are not in Zoom. Ariel, you mentioned a 1-year deferral. Can you repeat what the 1 year provides? It wasn't clear. Can you please repeat that?
Yes, the 1 year is a accommodation period, meaning that if a person comes to Israel, whether it's for the first time or as a veteran resident, veteran returning resident, he can elect that the first year will be an accommodation year. For what this is important, there are people that came to Israel and are not sure. They're not sure when they're coming whether this process of coming to Israel, the aliyah, will work out. And they're afraid that they come to Israel and after a few months they come back to the US and then, or any other place in the world, and then the 10 years of exemption clock will start ticking while they are not in Israel and they're not using these benefits. I mean, they want to come to Israel, but maybe they'll move back and forth and come back to Israel after a few years. And then they can elect, tell the ITA, well, I want to use this year as a recommendation year, meaning that if they will leave Israel before the end of this year, this year they will not be regarded as an Israeli tax resident in this year at all, and this will not trigger their 10 years of benefits. It's very important to people that are coming to Israel are not sure, but they know that somewhere, at some time in the future, they will not want to come to Israel. For example, you come to Israel, you know that in 5 years you will live in Israel for good, for sure, but maybe you'll come now, or maybe you'll come in 5 years, and you want to make sure that you will not lose 5 years of tax benefits, so you choose this accommodation period.
Okay, wonderful. I think Gary's happy with that explanation. So, okay, fantastic. If you have any more questions, Gary, feel free to just type them in the box below. I have a question here in crypto. So in the US, right, when you sell crypto and you receive fiat or regular currency in exchange, so that triggers a taxable event, right? That's a capital gain or loss. Now, unless you're a trader, which is treated separately. So in Israel, it's the same, correct? When you sell crypto for fiat, that'll trigger a capital gain or loss. So the question is, what about when you sell crypto for crypto? So if you give up one crypto and you exchange it for another, is that a taxable event?
Yes, in Israel, every transaction with a crypto is a tax event. I mean, if you buy Bitcoin, change it to Ethereum, change it back to Bitcoin, change it back to USD, every transaction is a tax event in Israel. Also, most of Israeli will pay a capital gains tax, meaning 25%, same as shares. If you're not trading with crypto or have a business of crypto. But every transaction, even moving from one cryptocurrency to another, you will have a tax event.
Okay, gotcha. Now, in terms of so taxable event being the difference between the purchase price and the selling price. So, and a follow-up question from that. So in the US, you have the purchase price, but you're also allowed to increase that basis in the coin or the NFT, whatever it may be, with it if you had to pay any fees or any sort of commissions or royalties. Are you allowed to increase basis with other cost items with the Israel tax system?
Yeah, basically all your cost-related expenses are getting into your cost basis. I mean, of course, the matic pay for it, but also if you have fees, if you have a lawyer here, if you have anything that you have to pay which is related to this will be added to your cost base.
Okay, that's helpful to know. Another question. For someone who's self-employed, someone is self-employed and they receive crypto as compensation for whatever service they have rendered. Now, when if they were paid in regular fiat, you mentioned that obviously self-employment taxes would apply. I think you mentioned that in your presentation. Would the same apply if they were paid in crypto, that it would trigger the normal social charges and that would apply if you were being paid in fiat?
So if you are self-employed and receive your income in crypto, first of all, it's like receiving any other income. You have to pay a tax on that as any other income that you have. And then when you sell it to fiat or any other currency, you will have a capital gain. I mean, the first action of receiving the crypto, you check the value, and this is your regular income. You pay income tax in Israel, you pay bitur leumi. If you're a tax person, you will pay also your national security on that. The next transaction will be capital gain.
Gotcha. Perfect. Understood. So basically the same as in the US. We have a question from Avery down below. I'll read it for the benefit again of those who are not on Zoom. Any type of capital gains are not taxable in Israel during the first 10 years. So he or she is seeking confirmation that capital gains are not taxable in Israel during the first 10 years. Question mark? Is that true?
It's not any type. I mean, if you are entitled to benefits or first-time Israeli tax resident or veteran returning resident, you are entitled to 10 years of exemption from capital gains on non-Israeli capital gain, which means that if you're selling an Israeli company share, for example, you will have to pay tax on that. If you're selling a non-Israeli company, you'll be exempt. But if it's an asset in Israel that you're buying and selling an asset in Israel, or a company shares in Israel or something like that, you will have to pay tax on that.
Okay. Avery is happy with that reply. Fantastic. I'm going to have a quick check on Facebook and see what's happening over there. See if there are any more questions from that side. No, there are not. So guys, any more questions? All right. So short and sweet. We're glad that we're able to answer all your questions here today. We'll not answer, but we have hopefully given you the key concepts that you need to take away and discuss with whoever your preferred advisor would be. Ariel, thank you for your time once again. Deeply appreciate it. And just to drive that message home, how can people reach you if they want to reach you? Remember, some people cannot see the screen and the slides that you had. So do you want to give a shout out to your email address, your website, your phone number?
I will put my website in the chat, and you can also Google Amos Katz & Co, Hebrew or English, and you'll find out.
Okay, so Ariel Katz, that's the guy that you want to talk to with any Israeli tax issues, and that's www.amoskatz.co.il. Ariel, thank you for your time. Appreciate it. See you next time. Bye-bye.